We've been talking about this Santa Claus rally, and the question is whether or not now did the Fed just steal Christmas. But there were a few things leading into yesterday's sell-off. So let's kind of get into that right now. Here's what you need to know before the bell this morning. Yesterday, the Federal Reserve, of course, announced that they did cut rates as expected. Language was a little bit more hawkish than expected. And the dot plot, which is the famous plot of the Fed, of the different Fed voting members' expectations of where rates will be, they published that out. That suggests that they will only cut rates 2 times next year. The market was expecting 4. So that kind of took some of the juice out of the punch bowl, so to speak, yesterday and really kind of spooked the markets a bit. First things first is that the Fed is never right about anything. And these predictions are the worst on just about everything they ever do. So just because they're predicting right now that they'll only cut rates twice next year, any sign of economic weakness, they're going to cut 6 times next year. So it doesn't really mean a lot, but the markets are just so hinged now to everything the Fed says that, we just have these big kind of drastic moves in the overall market. But yesterday, that's what happened. Again, now, before we look at this, in order to have a correction, we've talked about this numerous times, you've got to have all the right ingredients, right? It's like baking a cake. So I want to have a correction. What do you need for that? Well, I need extremely suppressed volatility, right? I need everybody to be very complacent in the markets and not be expecting a correction, because when people don't expect something, that really helps amplify the outcome. I need bad breadth in the markets, which we've definitely had lately. We've had some of those negative breadth that we've seen in quite some time. And momentum needs to be declining even though the market's not. And that's exactly kind of what was going on over the last couple of weeks. We had declining breadth. We had declining momentum across the board. And then you had the market that was not oversold yet. And so yesterday, when the market made this, or when the Fed made this announcement, all those catalysts that catalyst ignited all those ingredients in the mix and caused this panic sell-off yesterday, starting right at 2 o'clock. Markets were down 3% at the end of the day. Importantly, on a technical basis, we did take out the 50-day moving average. So in order for the markets to get a rally here into the end of the year, we need to get back above that 50-day moving average pretty quick. Tomorrow would be great to be back above. If we get a little bit of a rally today, tomorrow, get back above that 50-day moving average. That'll keep this kind of bullish trend in track, and we'll set up for that rally into the year. And particularly, the markets are very, very oversold here. Previously, when we've been this oversold on a short-term basis, we typically get rallies. So again, you kind of look back in history, when you have these big oversold conditions, typically leads to a rally in the market. So we'll see if the markets need to get together. If Santa Claus is going to come, he better show up pretty quick. That last 5 days of the year is going to be critical. So again, the sell-off is certainly kind of the setup now for that Santa rally. You've got a nice oversold condition. But again, this kind of negative breadth in the markets and things that we've seen here the last few days certainly are concerning. It was interesting very early this year, we had done some analysis, which, by the way, I have coming out tomorrow for 2025, using valuations to create outlooks for 2024. And our target for 2024 was 6,000. With yesterday's sell-off, if we get a rally in the year, and we're going to be right around 6,000, so we'll be pretty close to being on target based on expected valuations that we did last year. So tomorrow's article on the website is using current valuations and earnings estimates to predict outcomes for next year. And the real key to that is going to be earnings growth. If earnings don't meet expectations, next year is going to be a fairly flat year. And that's just because valuations are so elevated right now. It's going to be a very interesting outcome for next year. Definitely expect to pick up in volatility more so than anything else as we get into 2025. But overall, just kind of looking at this is not surprising that this happened yesterday. Markets were very complacent, and we talked about the risk of a bit of a volatility shift, and we certainly saw that yesterday because we saw a very big pickup in volatility that happened very shortly right after the Fed announcement. Now, this morning, it's going to reverse almost all of it. So again, we had this very sharp spike in volatility yesterday. This morning, volatility is already back to 20. So again, we're kind of setting up for that year-end rally, but pay attention to volatility. If volatility doesn't come back down, it's going to be hard to press that rally into year-end. But that's what you need to know before the bell this morning.